So I'm super excited to for Mark to share with us today. And I asked him to not hold anything back. So you guys gonna get to hear the good, the bad, and the ugly and the super ugly. Mark, thank you so much for doing the show with me today.
Yeah, thanks for having me. Just to start this off, I write four reports a year. I write two that are a snapshot of the current status of the industry. And then I follow that up with a Monte Carlo report where I'll model 10,000, 20,000 simulations of where I think the market's going to go in the next 6 months.
Mm.
I've not done the Monte Carlo report yet, but I did just upload my 2025 year-end report into the chat. So feel free to download that. And here we go. I think the way to frame this debate is to look back at the industry for the last 10 to 12 years. It is no secret that prior to 2, 3 years ago, we were in a very easy credit era. Fed held interest rates artificially low. The bond market seemed to be reacting in kind. Mortgage and credit card debt was historic low levels. And as a consequence, we had a real run up in real estate. Anybody who could walk and gum, all of a sudden, they were a multifamily operator. The problem with that kind of low interest rate environment is it masked a lot of problems that were endemic in the industry. It also
Mm.
allowed a lot of people who weren't really good operators to operate because it was just unprecedented demand for what I do, which is near and dear to my heart, multifamily. So prices just kept going up, cap rates kept going down, valuations kept going up. Everybody was making money. We were all fat cats and happy. That was, in hindsight, a historical blip in time. And where we're at now is a reaction to that and what a lot of people are calling a market reset. It's not 2008 and 9 where capital markets worldwide seized up and froze. It's not that at all. There's still plenty of liquidity out there. There are deals that are getting done, but the margins are a lot tighter for one thing. Cap rates have gone up, interest rates, the cap rates follow interest rates. So if interest rates go up, cap rates are going to follow, and then valuations are going to tumble. For those of you who don't follow this stuff as tightly as I do, just because the Fed does something doesn't mean interest rates on loans are going down. The interest rates are tied to bond rates, and there is often an inverse relationship between what interest rates do and bond rates. And so the first thing I do every morning, I get up and I check the 5 and 10 year, see where it's trading at on that day. For those of you who don't, again, follow this, bond rates are determined by an auction market. And so it just depends what market sentiment is given the prior days goings ons. And the bonds will be traded at a rate determined by a marketplace, not by the Federal Reserve. So it's really important that if you're going to be in the real estate game, you understand where bond rates are and where you think they're going to head. I generally think that they're going to trend down and to the right for the balance of this year, but that really depends on the anarchy that's coming out of DC. I don't care what your political persuasion is. The world is looking at the United States right now with abject horror. What's going on here? Bond buyers factor that into their calculus when they buy bonds. So I don't know how to put it any other way. I am neither left nor right. I am agnostic politically because I play with house money. I have to look out for my investors' interests. So I have to read the tea leaves very carefully. When we invade sovereign foreign nations and threaten to invade others, the bond rates are going to react. And look, I'll just give you one other factoid. The United States as a whole is highly overleveraged. We have $37 trillion in national debt. And the only way we don't go bankrupt is by selling bonds. That's the game, folks. And bonds are tied also to the oil market, which is why we're invading sovereign foreign countries, because it's got the largest proven reserves of oil in the world. You can start to see how, at a really macro level, world politics and goings-ons can impact you down on Main Street and how you do deals. So with all of that said, the last 10, 12 years was a relatively stable time in the bond world, and bond rates were reacting favorably to the offerings in the United States. That is not the case anymore. That's why interest rates are higher for a multifamily product. The good news is that since in the last 10 months, bond rates have fallen an entire 100 basis points. So last spring, they were trading around 4.6. Today, I think they're probably around 3.65 to 3.7. That's a 5 year. And so they are going in the right direction. Unfortunately, the industry did a lot of deals at these lower bond rate, lower interest in the last 5 years. Deals that were put together in 2021, maybe 2019 to 21, all went in with certain assumptions about our deals and how through financial engineering and value add exercises we can improve the NOI and then the value of the asset. And the classic formula is improve it, crank up the NOI, increase the value, do a cash out refi, pay your investors, stabilize it, manage it for 2 or 3 years, sell off, and everybody make 20 IRR and an APREF. That is no longer the case. Most deals do not pencil at a 20 IRR. Some people are still paying APREFs. If you can find a deal that works, it's great. But it's a much more challenging environment. I'm not saying it's impossible, but you've got to write to the new reality. So what, and that new reality is it's not pretty. 2026 is not going to be pretty. A lot of these deals that got put together in 2019, 2020, and 2021, those loans are maturing. What has happened is those operators have not achieved the upside on their deal. And now they are underwater because they haven't created value. They cannot do a refi because the value is not there. What's been going on in the industry for the last 3 years is, I don't know if you people have heard this, but there's this phenomenon called extend and pretend. What loan providers were doing with operators is they were extending loan and waiting for the market to come back down to where it was prior to high interest rates, inflation, tariffs. I think everybody recognizes now that's never going to come back, that we were in a historically low interest rate environment and that the market has reset back to the norm, the historical norm, with interest rates somewhere closer to 4%. These deals that were underwritten assuming a 3.2% or a 3.4% refi, they're cooked, they're done. So I did a chat GPT last week. I was trying to figure out how many deals nationwide are trading below a certain DSCR, that's debt service coverage ratio. And I thought it was low, but the result I got was there were 5,500 deals that ChatGPT estimated that are trading at a 0.75 DSCR, which means they're not even covering the mortgage and expense payments on the deal, and they're going to the hip to support the project on a monthly basis. That is not a sustainable business. Yeah, it's ugly out there. In addition to these macro forces, you obviously in a low interest rate environment, developers get interested. And we had a historical amount of new product delivered to the marketplace. We had 1 million units of product that got delivered in 22 and 23, maybe into 24. And a large percentage of that is still not absorbed into the market yet. That absorption is going to take, in some markets, another 18 months. Not only are you having demand being tempered by the interest rate environment, now you have supply working against you as well. Econ 101 from high school is where supply and demand meet those curves, that's your price. Both of them have shifted so that the price or the rent has dropped. And it is very challenging to fight those forces and try to get the rent you need to be able to get out from underneath this asset. A lot of operators are not going to make it. I hate to say it, but going back to politics, I cannot tell you how many times in my 4,500 doors, I've had ICE roll up on my properties and kick them in. I can't even tell you how many times I've gone into units and my tenants have skipped. And so now I'm seeing vacancies spike on my deals and we're furiously trying to release them. But it's a really challenging time for my demographic profile. I own a lot of doors in Houston and a lot of my tenants are immigrant, Hispanic, Vietnamese, Cambodians, you name it. They're from all over the world renting units from me and they're terrified. And so now you've got this force driving down just your vacancy and or occupancy, increasing your vacancies. We're like any other operator out there who's got a portfolio. We're struggling to keep up with it all. We're holding our own, but it is a lot more work than it used to be. And I think the conclusion that I can leave people with is you need to be a strong operator in this environment. And lenders are really scrutinizing your operational chops. If you're trying to do third-party management and sub all that out, the expense for all this stuff is going up. I didn't even talk about the expense side of the ledger. You've got rising tax, rising insurance, labor costs going up. Your margins are just getting really squeezed no matter what you're looking at. It is a really challenging inflection point in the industry right now. I anticipate that 2026 is going to be the turning, and that's where lenders are going to just finally call these notes, put these out to auction, because here's the other thing. Who's done the vast majority of loans in the last 12 to 15 years? It is not commercial bank, private equity. So what private equity, their rationale for the extend and pretend is as long as they kept that asset on the income side of the ledger, they look like king. They're not taking a loss. They're still paying returns. What they're doing is charging big extension fees to operators, 500, 700, $800,000. When they're making money that way, as soon as they pull them over to the expense side, or even worse, the bad debt side, those private equity firms tank. In addition to a lot of deals that are going underwater, I really sit here and wonder about private equity and how many private equity operate. So this is a huge systemic problem. That said, capitalism is a great thing. It has a way of filtering out the wheat from the chaff, and that is what you are going to see in the next 12 to 18 months. You're going to see stuff just flushed out of the system. Deals will get bought up at a lower basis. They'll operate efficiently again, and life goes on. So the real question is, what side of the fence are you going to be on when this all goes down? And again, I want to emphasize, this is not the world economy collapsing. Just real estate as a whole is really challenged right now. I can tell you two anecdotal stories. I was just reading a LinkedIn profile about Phoenix. Oh my God, Phoenix is just every kind of wave. I watch it. It's a sand state, right? So they just keep building further and further out. The West Valley of Phoenix, where I play, is nothing but plenty of dirt. Folks go out and buy farmland, throw up Class A products. Every one of those Class A products is offering concession, 3 months free or some shit. Phoenix is going to have to grind through it like they did in 2008 and 9, and they'll recalibrate and life will go on. Another anecdote for those of you in office product, the most venerable office operator in Seattle, who's been in business since 1958. Now, at one time, he owned 33% of downtown Seattle. Martin, he is $1 billion in the red because he cannot
Wow.
lease up his product. And it's older product that needs a lot of work. It's a lot of deferred maintenance. And at the age of 85, he's going to go bankrupt. So there's a lot of pain out there right now. And I don't know if you can point your finger at any one thing. I like to frame it as the market is resetting. It was a big party that went on for a lot of years, and the party's coming to an end.